guys, I just wanted to create a short video on currency exchange and just talk about a few things because as you finish your currency assignment over the next 5 to 6 weeks, you're going to have to talk about what is impacting your currency fluctuations and what you see. So I'm just pulling up an article here on Investopedia. This is a great resource for understanding currencies and issues in currencies, and you're going to find it very similar to stock trading. If you've done that in a financial accounting class, it's very similar to that. But this video is a great 3-minute synopsis of what I'm going to go through, so certainly take a look at that. But basically, there are a number of influences to currency rates and why they fluctuate. One of the things that you may have noticed is maybe one of your currencies doesn't fluctuate very much at all. I'll use the example of, I'm just going to do US dollars here and do China so that you can see what's happening. So if I look at China, it did not give me China. China, thank you. As you can see, it's the same. No, it's not. So you can see with China, the conversion chart over the months stays relatively the same. So the Chinese government actually will manually adjust their currencies. They don't let it float as much as other countries do. As an example, if I would do 1 to the euro, you'll see a lot more fluctuations, and it's relatively stable, but it's been up and down, especially with the Brexit news, and so it does jostle frequently. If I change this to maybe Mexico as an example, we might even see more fluctuation. Yes, different types of fluctuation, right? So each of these currencies are going through different types of fluctuation. The Chinese government actually artificially reduces the value of their currency. They devalue their currency a little bit. The reason for this is a devalued currency will help increase trade. So if your currency is cheaper than other currencies, people will want to buy more of your product. So when the American currency, the US dollar, is high and strong, it's not very good for manufacturing. People don't want to buy our product. However, as consumers, we can buy other people's products very cheaply, and that's a benefit to us. And then vice versa, when our dollar falls, our market, like our manufacturing market, looks very good to other countries, and they want to buy more of our manufacturing. However, we're not able to, as consumers, purchase as much from other countries because our value is less. It will appear more expensive. And generally, that conversion rate doesn't lend itself very well. And this has always been the case. I think the easiest one to really think about, because maybe you've been there, is Canada. So the Canadian currency is not as strong as the US dollar, and so a lot of times if you look at like the back of a book or different, it'll give you 2 different prices, the price in Canadian dollars versus the price in US dollars, right? Because that's to make up for the difference in the currency valuation. Okay, now there's 2 different ways to look at currencies, and you've been noticing this as you do your conversions, is 1 US dollar equals 1.34 Canadian dollars, so you're getting more Canadian dollars for your buck, right? However, if you're transferring it back, the Canadian dollar to US, you do lose some money, right, in that transaction. Not necessarily losing if the values stay exactly the same. You don't really lose anything. It's just kind of a 1-for-1 conversion. But if you were in Canada buying US dollars, you wouldn't get as much. Same when we buy euros, we don't get as much, or pounds. So being aware of what that conversion rate is really important, but then it can fluctuate dramatically. And one of the things, I think there was an article about, let me see if I can pull it up here. There's an article about Coca-Cola and yes, in Venezuela. And Venezuela lost the currency, of course, has just been ridiculous, and this has been going on for a while. So this probably was several years ago. Oh, this says March 24th, 2019, but this actually happened a couple of years ago as well. But Coke takes a $247 million loss from the Venezuelan currency. So in 2014 is when it happened. So I knew it was a few years ago. So in 2014, the currency in Venezuela dropped significantly, and because the value of the currency dropped, Coca-Cola lost $247 million. So currency really makes a huge difference for businesses, especially when you're going global. And there's a number of ways that you can help influence that so that you don't take the hit, but it can cost a lot of money. Think about it from a Coca-Cola perspective, $247 million just from Venezuela, one country that they do business with. So some of the reasons why currencies fluctuate when the government, like in China, doesn't have as much, they're letting it float and not maybe devaluing it like China does. So like the US fluctuations or Europe fluctuations that tend to float more freely, they're definitely impacted by inflation. So a country with consistently lower inflation definitely has a rising currency value. So its purchasing power increases and the value of that currency increases, okay? If you have high inflation, then your currency starts to lower in value, and that purchasing price parity, as the book discussed, a hamburger might not be the same price using the Big Mac index in one country as in another, so you can't get as much for your money, and that's a problem. And some of you talked about that depreciation and the devaluation. Differences in interest rates can also have a huge impact on currency. So interest rates, inflation, and exchange rates are all highly correlated. Countries manipulate interest rates. So while we have a free flow currency, our government still controls the interest rates, and they have an influence over the value of our currency because they do that. So even though we boast that we have a floating currency, it's still somewhat managed because of some of these things like interest rates, right? And so the government still has a hand in manipulating that. So higher interest rates offer lenders in an economy a higher return relative to other countries. Therefore, higher interest rates attract foreign capital and cause exchange rates to rise. So the higher the interest rate, the higher the value of your currency tends to be. Now, as borrowers, we don't like high interest rates. So there's winners and losers in this discussion. The current account deficit is really the balance of trade between a country and its trading partners. We operate in a deficit, and we have since the 1980s. This is just kind of a normal occurrence for us. And so the reason for it is because our dollar value is so strong that we do import more than we export, and we've had that happen since the 80s. I don't foresee that changing. I think if our value of our currency fell to the point where we had a balance, I think we'd have other issues. So I know a lot of politicians talk about, and everyone, whether it's Republican or Democrat, talk about balancing our trade deficit. I'm not sure. I mean, it hasn't happened since the 80s. I'm not sure what that would look like, because the 80s, the 70s at least, wasn't a really great economic time frame for us. So the 80s is when we finally started getting out of that deficit we were in. And I feel like we're in a better place now. So I'm not sure I'd like to see it totally balanced, but it's interesting. I guess it'll be interesting to see it if it ever plays out. Another issue for this is public debt. So countries that are engaging in large-scale deficit financing to pay for the public sector projects and government funding will definitely impact your value of your currency. So you become less attractive if you borrow more money to other people. So the higher your public debt is, the less likely people will purchase your currency. And then in terms of trade, the export prices to import prices is really related to current accounts and balance of payments. And if you have rising revenues from exports, that increases the demand for your currency. So that kind of all plays into. So an example is if you put a lot of tariffs and you don't have people wanting to buy your product, then you are definitely impacting the terms of trade so that the balance of payments becomes skewed and probably will lower the value of your currency. So that's how that is kind of tied into that. And then political stability, economic performance, I would put this all into like news. So think of it as a bandwagon effect. If bad things are happening in country, people stay away from it. Bad things are happening in Venezuela, currency aside, people will stay away from that right now because it's a risky country. And so those types of things, all the news articles can also have an impact. Brexit, a lot of those things can have a huge impact on currency. So as you're doing research to look at currency for your final summary, think of those factors. This is a really great link for that. The other thing I wanted to show you is on xe.com. This is the one that I use primarily. There's a number of different resources out here. There's blogs on daily market updates for different currencies. There's a currency encyclopedia. So let's say you invested in the Swiss franc. It will give you a whole bunch of information on the Swiss franc and maybe some history of what's happening right now. You can get more information on here. Let's see what else is out here. So it gives you just a little bit more information on your currency itself. The blog, though, is going to give you information on like actual things that are going on today. So people are talking about the US dollar shrugs off a dovish Fed. This is market analysis in Europe, market analysis in Asia, the dollar rebounds. This is just a few days ago, so this is all current information, and you can just kind of sneak through here to see if you see anything specific to your currency. I'm going to try not to sneeze. And so this is another place. So a lot of these sites will give you very interesting lessons on currency and trading and things like that. So what do businesses do to impact this? A lot of times if you have a catalog for customers outside of the US as an example, you might change your prices periodically, maybe quarterly, maybe monthly, so that it takes into consideration the difference in the value of currencies. Some people, for their foreign business, they don't publish their rates. They do a spot rate and have people call and they'll quote it at the time. So there's a number of ways to hedge the currency issues that you might have, but it's definitely a big deal if you're not paying attention to it, and it can come back to haunt you. So the other thing you can do is just sell everything in US dollars. So they have to purchase it in US dollars and then they take the loss. So lots of different ways to do this. You can use, I think they talk about in the bottom here, you can use different brokers to help you with it, things like that. So there are people who are very experienced in this, but I just thought I'd share because it's a confusing topic.